It has been 50 years since the first edition of A Random Walk Down Wall Street was published. The investment advice of the original edition was very simple. Investors would be far better off buying and holding a broad-based index fund than attempting to buy and sell individual securities or actively managed mutual funds. I boldly stated that any information affecting the prospects for individual companies would be quickly reflected in the prices of their shares. In such a situation, a blindfolded chimpanzee throwing darts at a listing of stock prices could select a portfolio that would do as well as the portfolio selected by experts. Of course, the advice was not literally to throw darts. The more correct analogy was to throw a towel over the stock listings and buy and hold a portfolio consisting of all the stocks in a broad stock market index. Such a portfolio is likely to outperform professionally managed equity funds whose high yearly expense charges, substantial trading costs, and tax consequences detract from investment returns. Now, 50 years later, I believe even more strongly in that original thesis, and there's a seven-figure gain to prove it. An investor with $10,000 to invest at the start of 1977, when the first index fund became available, would have a portfolio worth $2,143,500 at the start of 2022, assuming all dividends were reinvested. A second investor who instead purchased shares in the average actively managed mutual fund would have seen the investment grow to $1,477,033. The difference is astonishing. Through January 1, 2022, the index investor was ahead by $666,467, or a staggering $250,000. Today, there is broad acceptance of the idea that index investing is an optimal investment strategy. Currently, more than half the money invested in equity mutual funds is in index funds, and trillions more are invested in indexed exchange-traded funds, ETFs, index funds that trade in public securities markets. But at the beginning, the idea that investors should buy index funds was ridiculed as foolish and imprudent. To say that Random Walk did not generate a positive initial response would be a vast understatement. The first edition was reviewed by a stock market professional in Businessweek magazine, where it was thoroughly trashed. The reviewer believed that the ideas presented were naive at best, imprudent at worst. Why investors should be satisfied with guaranteed mediocrity puzzled the reviewer. Other reviewers described the idea that our financial markets were reasonably efficient as one of the most remarkable errors in the history of economic thought. Fortunately, I was not deterred. I figured that if no one hates what you have written, perhaps you have not published anything worth writing. You can always avoid criticism by saying nothing and doing nothing. 3 years after the initial publication of the book, Jack Bogle, the CEO of the Vanguard Group, introduced the first index fund that would be available for the public to invest in. The reception of the first index fund was no better than that for Random Walk. Vanguard initiated its new fund by hiring a number of Wall Street investment bankers to sell $250 million of the shares. The bankers could find buyers for only $11 million. While Vanguard was willing to sell more shares of the fund at zero commission, buyers were still scarce. I used to joke with Jack Bogle that he and I were the only shareholders. The fund was widely described as a failure. It was called Bogle's Folly, doomed to fail, and even un-American. For many years thereafter, the index fund attracted little capital. As optimistic as Jack was about indexing, even he could not have imagined that index funds would eventually attract trillions of dollars in investments. In these pages, readers will find considerable support for the idea that our markets reflect new information without delay and are highly efficient. Moreover, the convincing evidence accumulated over years should make even skeptics believers in the indexing propositions I have promoted. Most important, the book has always been meant as a comprehensive investment guide, and the very practical uses of these ideas will be clearly explained. But before we begin, I want to tell you as simply as possible what is meant by the term efficient markets, and how that term is often misinterpreted in the press. And I want to make clear the common sense arguments in favor of making index funds the core investments for anyone saving for a comfortable retirement or to achieve financial security. The theory behind the view that indexing is the best way to invest the core of your portfolio